If you're invested in the stock market, you need to know about taxes and how to invest so that the taxes are in your favor. This is part 1 in my series of stock market taxes for beginners explained. Now, quick disclaimer, I am not a tax professional. I am not an accountant. This is just based on my own personal research and experience. So please always do your own research and due diligence and don't just trust someone on social media. In this series, I'm going to teach you what to do with money that you make in the stock market, what to do with money that you lose in the stock market, your dividend income, your interest income, and how to reduce your tax burden in the stock market. So if that sounds good to you, follow along. Let's start with the basics. In the stock market, your taxes are calculated based on the calendar year. So from January 1st to December 31st. And your brokerage account is the one that will keep track of all of your activity in terms of gains, losses, interest, dividends, etc. Now, to make sure we don't miss any important tax deadlines and documents, we need to take a look at the calendar. So let's just say December 31st is over. It's now January 1st. Happy New Year. By February 15th, your brokerage company, whether that's Fidelity, Vanguard, Charles Schwab, etc., they are required to send you what is called a consolidated 1099 form. And this form is a form that you need in order to file your taxes for the previous year. And this form includes 3 different forms. It includes what's called a 1099-B, which is going to have how much money you made or lost in the stock market last year, a 1099-INT, which states how much interest you earned in your brokerage account for the past year, and a 1099-DIV or dividend, which will report the amount of dividends that you earned in your brokerage account for the past year. Now, you might be asking yourself, well, why can't my brokerage account just generate these documents on January 1st? Well, there's a reason for that, because there are certain types of transactions that you might make within your brokerage account that can retroactively affect your taxes. Let's say that 2025 has ended and it is January 15th of 2026. What you do in January 2026 can affect your taxes in the previous year. One example of this is what's known as a wash sale rule, and I'm not going to get into the specifics of that, but just know that that is the reason why brokerage companies cannot generate a consolidated 1099 on January 1st. Worst case scenario, you get your consolidated 1099 form mid-February, and that gives you plenty of time to finish filing your taxes by that April 15th deadline. Now let's go over some of the most common situations. So in the stock market, you will only pay taxes if you make money. If you lose money in the stock market, you will not pay taxes. In fact, if you lose money in the stock market, you will actually get a tax deduction. Let's look at an example of if you make money